Hi, good morning, everyone. Welcome to this webinar on the impact on the UK economy of investment and hiring, where we will take a look at the latest results of Deloitte's CFO survey. We're joined today by Debapratim, who is the senior economist at Deloitte, who will be presenting the results. And then we will be joined by Jonathan Firth, who is the senior managing director at Page Group, and Kath Shimmin, chair at Blake Morgan, for a panel discussion which is kindly being facilitated by Ryan Cooke, operating director at Page Group. There's going to be plenty of time for questions, so if you would like to ask a question at any point during the session, please use the Q&A function, which you will find at the bottom of the screen. And just to make you aware also that this webinar is being recorded and will be made available on the Thames Valley Chamber of Commerce website shortly after the session. So without further ado, I will pass straight over to Debapratim to present us the results of the survey.
Thanks, Rosie, and good morning, everyone. Over the next 10 minutes or so, I'll aim to share with you our outlook for the UK economy and essentially views on what we are seeing across the economy, the major economic themes affecting growth over the next 2 years, and also what we are seeing in our Deloitte CFO survey, which is a survey of CFOs of some of UK's largest businesses. So they're typically FTSE 350 or very large private companies that are represented on the panel. So it's a view from the top end of the UK corporate sector. So I'll be looking at some of the key findings from our latest survey, which show how these big businesses are responding to this economic backdrop. Now, the first slide that I've got looks at basically the biggest factor influencing growth and activity in the UK over the next couple of years, and that's inflation. The chart here looks at the evolution of inflation so far, and it's also got our forecasts for the next 2 years. Now, the interesting thing here is you'll notice that there are two different profiles that we're forecasting, and those profiles are contingent on whether come April the government extends support on the energy price guarantee for households. The government is planning to actually target support better. So the government has said that it's not going to offer blanket support to everybody, to all households, but nonetheless, if it provides support to a significant majority of households, we think inflationary pressures will peak at about, or rather inflation will peak at about 11%, and that will happen this winter. After that, throughout next year, inflation will fall, and that it will continue on a downward trajectory the following year. Now, if the government ends the energy price guarantee in April, then we think inflation will peak next spring at about 13% and start falling after that. Now, it seems likely that there will be an extension of the energy price guarantee. This is what the Bank of England also assumes in its latest monetary policy report. So if we were to assume that for a minute, then that means we are very close to price pressures peaking. And that's a good news because we should start to see inflation fall from next year. But the bad news is that despite falling, price pressures are likely to persist. So in the forecast that we've got here, despite falling throughout next year, inflation drops to just 4.5% by the end of next year, which is still significantly high. It's double the bank, or more than double the bank's target rate. And the reason why price pressures are likely to persist is because even though this bout of inflation has been caused by supply disruptions, has been caused by the rise in energy prices because of the war in Ukraine, we are seeing these price rises actually feed into the rest of the inflation basket. So core inflation for the UK, which strips out the effect of energy, food, alcohol, which tend to be quite volatile, these prices, even that is running at about 7%, so just under 7%, and it's rising. So we are seeing price pressures having spilled over into other parts of the economy from their source, and it will take some time for that to normalize. Also, we're running a very tight labor market, So firms have actually increasingly struggled to hire people. And in this sort of environment, actually, there's continuous pressure on wages. So again, that's something which will keep inflation at a high level. Now, what we are forecasting as a consequence of this is actually a recession in the UK. We think the UK economy is already in recession, which started in the third quarter of this year. And we think this recession will last for 5 quarters. Now, in terms of the hit to GDP that we are likely to get this time, we are forecasting a 2% peak to trough fall in GDP. This is a much smaller contraction than our last 2 experiences of recession. So during the pandemic, we saw a 20% fall in GDP. And during the financial crisis, we saw a 5.5% fall in GDP. So this is much smaller than that. Having said that, it will still feel quite disruptive. And I've got a couple of charts in the following slides that talk about some of the disruption that we are likely to see. Now, the first chart that I've got here is on unemployment. And really, this is, these are the figures for unemployment, shows the evolution of the unemployment rate and shows what our forecast is for unemployment. Now, many people think that actually because the labor market's really tight, we're not going to see a rise in unemployment this recession. We think that is unlikely to be the case. We think that actually demand and cost pressures are already hitting corporates. And as they intensify, they will drive unemployment. Even if you look at big businesses that have deep pockets who might think that actually we've really struggled to hire people and so we hold on to them through this recession, small and medium enterprises may not necessarily have that luxury. And if you look at the chart to your left, which looks at company insolvencies in the UK, the anomaly in that chart is the pandemic, during which insolvencies actually didn't rise. In fact, they fell. So we saw a really sharp shock to activity, but because blanket support was provided to businesses, a lot of businesses that couldn't deal with perhaps a milder shock, which is what we are seeing now, survived what was a much sharper, much deeper hit to activity. And what we are seeing increasingly is that a lot of these businesses are now folding. So we've seen a sharp rise in insolvencies over the last 3 months. You can see that over there on that chart, and we think this will rise further. And that is because a lot of small and medium businesses also will see support on energy prices expire in April. So come April, they'll be looking at a significant rise in costs at a time when actually there will be there'll be a squeeze on demand. So you might see a further rise in insolvencies, and there's no way that small and medium businesses fold without a rise in unemployment. So we are forecasting unemployment to peak at around 5.5% in 2024. Unemployment typically, it lags activity. So even though we will be out of a recession, according to our forecast by the end of next year, unemployment will still continue to rise, and it will peak at 5.5% in 2024. Mind you, this is still going to be a fairly tight labor market. If you remember when Mark Carney became governor of the Bank of England, he had said that below 7% unemployment, he was going to start raising rates. So that was seen as a very tight labor market. We are now talking about unemployment peak at 5.5%. That's much lower than 7%. So it will still feel like a tight labor market. Having said that, at a time when unemployment starts rising, you're going to start to see some pressure on wages ease. And so we expect nominal wages to be rising at a slightly slower pace than what we have seen so far. Nominal wages have been rising at around 5%, 5.5%. So if that pace falls to 4.5%, then that means, given our forecast for inflation, which is 4.5% and higher for all of next year, you will see a real wage squeeze last for most of next year. So you're going to see this real wage squeeze continue, and that's going to drive the hit to demand. The second way by which demand will get affected is through higher interest rates. And the chart to your left looks at market rate expectations for the summer of next year, for the end of this year and the end of next year. And as you can see there was a sharp rise in rate expectations after the mini budget in September. And with the change in government and the change in fiscal policy, or rather the reversal to fiscal orthodoxy, we've seen rate expectations come down, and markets now expect interest rates to peak at around 4.7% in the summer of next year. I think they might peak at a slightly lower level, may even be 4.2% or 4.5%. But in terms of the pass-through of this, actually, households, there'll be millions of households that will see a significant rise in mortgage payments. But at an aggregate level, the chart to your right, it shows you interest rate payments and how the base rate has moved. There's going to be a significant lag because the majority of people who've got mortgages, which is actually about a third of British households, the majority of them actually are on fixed rate mortgages and typically 5-year fixes. So it's going to take them some time to see what would be a significant rise in their mortgage payment costs. So in terms of the household sector, we haven't quite seen the full impact of these rate rises, and it will take some time actually for these to feed through. So if you expect these rate rises to show up as a squeeze on demand from households, that's going to take a little bit of time. For corporates, as the next slides will show, this hit is already here because the vast majority of corporates actually borrow money on variable rates. And these are charts from our CFO survey, and these are some of the largest British businesses, as I explained earlier. And a lot of them are reporting a significant rise in credit costs and a drop in credit availability. In fact, this is the sharpest rise in credit costs in more than a decade for some of the biggest, most solvent British businesses. So you can imagine that the current tightening is already showing up in the corporate sector. Now, when you add to these higher financing costs the expectation that they're going to see a hit to demand and therefore weaker revenues, what most businesses are expecting is a huge squeeze in margins, and that's the chart to the left, so to your right, which is again a chart from the CFO survey, and these are what CFOs think margins might do over the next 12 months, and essentially on balance they expect a significant squeeze on margins. So for a lot of businesses that haven't necessarily yet seen a big hit to demand, they are expecting that hit to come through over next year. But in terms of rate rises and higher operating costs, this crisis is already here for them. Now, what are they doing to respond to this? What we are seeing is basically a reversion to what corporates tend to do in these recessionary times, which is they focus on reducing costs. So there's a huge focus on cost reduction. It is their top priority for the next 12 months. They're also looking at cash control, so increasing cash flow is another serious concern. They haven't quite given up entirely on expansionary strategies, so introducing new products and markets or services or expanding into new markets is their third biggest priority. But as you can see, by far, cost reduction is the top priority for some of the biggest British businesses at the moment. And as I had said, that we're likely to see some slack open up in the labour market. If you look at surveys of corporates and their outlook for corporate hiring, actually they expect hiring to decrease over the next 12 months. So this is it's a measure of labour demand. It's not really a measure of overall employment, but essentially what they're saying is that demand for labour is likely to cool over the next 12 months. So really, in summary, we think that the UK economy is heading into a recession. The energy price cap and developments in energy markets will deliver most likely a lower peak in inflation, and they'll support household spending. Monetary tightening should continue. Markets are pricing in rates to peak and now at about 4.75%. We think they might peak at a slightly lower level than that. Having said that, there's still tax rises and spending cuts to be announced later this month, and we'll be looking very closely at that to see how that affects our forecast and how that could affect the economy. So that's one major unknown that we still need to consider. But the downturn is much likely to be what we saw during the early 90s. So it's milder than the pandemic or the global financial crisis. So it's quite different from the working experience of recessions for a lot of us. And we expect insolvencies and unemployment to actually rise, and to some slack opening up in the labor market. Now, the only issue I have with this is what I think what I have laid out is actually quite an optimistic view, simply because if we've got 20% or higher inflation, which is what many people were forecasting a few months ago, and we go from there to 2% inflation and things becoming normal with just a 2% hit to GDP, then it's actually a relatively benign outcome. And I think the real risk is that inflation proves more persistent than forecast for a number of factors, because there's a lot of uncertainties involved with energy prices. We don't quite know whether core inflation will really start easing off next year. So there are risks to this, and there are downside risks. Now, the issue is, despite what I think is a very optimistic forecast, we are really at the bearish end of the forecast spectrum. So most economists are actually much more positive than us on this. We have seen the consensus move towards us over the last month and a half, and we think it's going to move further towards us. But one downside risk that I would say you should keep an eye out on is whether core inflation, which is inflation once you strip out energy and the other volatile bits of food, alcohol, whether that persists and whether that stays at the level that it is in which case the bank really will be forced to raise rates aggressively and drive a much bigger recession. So at this point, I'll hand over to Ryan, and then if there's questions, I'll be very happy to answer them later. Thanks.
Thank you, Debo, and thank you for cheering us up on a Wednesday morning. And I agree. I think there's a broad church, isn't there, of optimism, I think, on what could possibly happen next. And it's interesting, you feel that there's others that are more optimistic, so maybe we can hang our hat on that. But without further ado, may I introduce Jonathan and Kath. And Kath, if I can come to you first, just to briefly do introductions before we sort of move into comment and reflections. But Kath, I'll pass to you.
Morning, everybody. I'm Kath Shimmin. I'm chair of Blake Morgan. I'm a banking and finance partner at Blake Morgan. I think I share everybody's universal depression at the moment following that that introduction. So I've got plenty of thoughts, but I'm sure you'll want to round us to corral us all, Ryan. Hello. Oh. Hello, are we still there? Apologies, everything seems to have gone very quiet.
I can hear you, Kath.
Okay.
Kath, I think we've lost Ryan.
Okay, well, in that case, why don't I give some feedback on Debo's thoughts, and we'll wait for Ryan to find us, to rejoin us. I think most of what we will have just heard is probably what we're all expecting, and I think the key for everybody on this call now is what can we constructively do to keep the wheels on while we weather what is almost certainly going to be a perfect storm. For a lot of people in the services sector, and I know we've got quite a lot of people on from the services sectors and from the tech sectors, where what you have is very highly skilled employees. You're looking continually at this rather odd situation where wage pressure continues to be absolutely toxic. But at the same time, we've got CFOs saying that they're looking to actually reduce their hiring plans over the next few months. I think it's one of those things that's probably going to play out differently in different sectors. And therefore, I think, it is going to depend a little whether you're looking at highly skilled technical or service professionals. Healthcare, of course, is another area where hiring is incredibly difficult at the moment. And the government's not making it a huge amount easier with the way in which it's approaching hiring in from overseas. I think the way in which businesses approach insourcing and outsourcing will be interesting. There's always a cycle with this as to which is cheaper. And it may be that for some businesses now, looking at outsourcing is a better model than constantly trying to hire to fill difficult positions. And that may be something that some of us would want to consider. But also, I think it's really a lot about looking at your own workforce. Yes, of course, it's inevitable that in a squeeze like this, people are not going to be looking at hiring in the same way. But I would say don't lose the focus on retaining what you've got. Look at your retention strategies, look at what you're offering your existing staff and how you can help them to stay with you through what's going to be a difficult time when undoubtedly, there are struggles around managing wage inflation. And at the same time, with that rather dismal picture of what inflation's likely to look like over the next 9 months to 18 months, you're seeing, staff and employees increasingly squeezed as well. Is Ryan back with us, Rosie, or shall I just plough on?
I think you can continue for now.
All right, I will carry on then. I've got loads to say, so that's fine. Do feel free to interrupt me. So yeah, I think, staff retention, and I think that also plays into the point that came through about looking at productivity, which again is an endemic difficulty, it seems to be in the UK. But, this is a real opportunity, I think, to sit down with staff and talk about how they want to work and what makes them productive. Because that also plays back into the hybrid working model, where I think employers have a lot of fear as to the extent to which hybrid working will damage productivity. But I think handled correctly, it can become a really powerful tool, in leveraging the productivity of the staff that you have and in retaining them and incentivizing them. Because, I just think, at the moment, any difference that you can offer to other employers, particularly in terms of this approach, will make you a very attractive employer. I was going to come on then. I know it's not quite strictly within the bounds of what Deba was talking about, but the issue around financing costs going forward. I think for businesses, there are a number of concerns around this. First, obviously, the movements in the mortgage market affects consumer appetite. And I expect we will be seeing consumers already battening down the hatches for expected mortgage rate rises as fixed rates peter out. Businesses that are themselves externally financed will be doing the same exercise, because if you have, you may be lucky enough to have a facility where you have actually hedged. There has been quite a popular move towards buying caps rather than straight swaps in recent months and years. So if you have been smart enough to buy a cap, congratulate yourself, and but don't feel too smug for too long. So there are products out there that may be protecting one against interest rates. I think the other thing to do is to get your financial covenants out now, dust them off, have a look, and see where you think the pinch points are coming. Because you're not going to be alone in facing this, and we're already seeing bank clients coming to us talking about covenant resets, sensible measures to deal with the pinch that's coming. So I've said pinch a lot, but it seems to be the right word at the moment. So I wouldn't shy away from doing that. Make sure you know where you're on solid ground and where you think your weaknesses might be, and then maybe sit down with your bank and try to plan for that. Whether or not moving into equity finance is a good idea, I think depends on whether you're looking long or short term. There's certainly a lot of equity funds out there with money to spend at the moment. But of course, equity investors expect quite often a bigger return than you might immediately see. So it's a question of whether you want to pay now or a pay later model. And also, I think the extent to which you feel that you can deal with the challenges of having an equity investor on board who may not be one of your founder shareholders and who may therefore not have quite the same philosophical approach to your business as you do. But certainly, there are opportunities out there for that. I think it's very difficult to see, where the market's going. Obviously, we've already seen that the projections on if you look at the hawks, all the doves on this, that there is nothing good coming. So I think we must assume that we're in for a very choppy few months. And I think that, it is really important that people pay attention to the information that's coming through, see what their peers are doing, and just really think hard about what strategy makes the best sense for you. Do we want to throw things open to general comment at this point, Rosie? Have we got questions coming in?
I haven't seen any questions just yet, but I think maybe this is an opportunity to bring Jonathan in for his thoughts.
Hi there, thank you. Yes, I'm Jonathan Firth and I'm a Senior Managing Director at Michael Page. And so probably worth me giving a bit of thoughts around the labour side, which is difficult to assess at the moment. Whilst Debapratim says he's a bit bearish and others are probably a bit more bullish, I would certainly say the analysts following the recruitment sector are even more bearish about the UK side of it and labour markets. And obviously, the talent shortage in the UK has been part of probably what's tipping us into recession. So there is quite a lot of slack in the market from our side to make up. And, what we've already seen in the city, for example, where M&A is significantly down and a lot of banking results are way down from the previous year. But we've remained as busy in those markets as we were before, and that's probably just taking up some of the slack. However, we are seeing labour demand reducing, not significantly, but month on month it is beginning to reduce. But as I say, there's quite a lot of slack in that market because certainly we were unable to get anywhere near filling all the roles that we had anywhere. And I suppose it's how far does that labour market go down for us to begin to make an effect? I think fundamentally, does a downturn solve the labour shortage problems? Well, the answer is no. We have a historical and systemic shortage of talent in this country. There's a whole range of surveys, but the latest has that, we're short of 4 million skilled workers in the UK at the moment and 6 million unskilled workers. And whatever the downturn and shortage in the labour market, that's not going to wipe that out. And it is something to continue. We also have some particular still from the pandemic issues around that. 1 million people left employment in the UK. I know that's a big factor that the Bank of England have been looking at and is a major issue in our labour market at the moment. 600,000 Europeans went home and haven't returned. That's another major issue in our area. People may have seen statistic recently that I think there are 2.5 million people not in work due to long-term sickness at the moment, and that's the highest since records began. So if those keep increasing, obviously that puts pressure on. If those decrease, obviously that will take pressure off the market. So I think the labour shortage will increase and be better, but will still be there. It's a little bit sector by sector. Certain areas of technology, we're going to remain short. Life sciences, I'm afraid probably areas like legal as well, skilled areas like legal, those shortages will remain. The one thing we feel the government can do, and has been a major difficulty in the last couple of years, is actually immigration, and the reduction of people coming in internationally into the UK has been a more significant issue than we saw, and opening up those markets would help. I think on the wage pressure side, we do see actually that helping, because I think it's been a real toxic mix for organizations at the moment. Obviously, you've got the high inflation and the fear of inflation. You've also got an incredible job market where they can walk out and get another job extremely easily. So the ability to vote with their feet has put increased pressure on companies to do something about that. We already are beginning to see that balance changing from people very much being focused on increasing their salaries in the first half of the year. Increasingly during the second half of the year, people have talked about going into organizations where they can be more safe for the next 2 years, where actually they can feel to be more stable. We've had people coming off the market because they don't want to be the last into an organization going into this area. We're also getting reports from clients with worries that they have brought people in at significantly higher salaries than a lot of the more loyal employees who've been with them for some time. And they're now beginning to see that actually performance isn't particularly increased by those who are costing more. And they're beginning to try and plot through what they do about this, because obviously they don't want to increase costs, but there's a disconnect there, and they're beginning to see the issues with that. So actually, we predict coming through next year, we will begin to see some people coming out into the market who probably were slightly too expensive this year and have made the most of the market. And one of our challenges will be dealing with people coming out to the market who are probably a little bit more expensive. So that balance between inflationary pressures and, for want of a better word, feeling lucky to have a job and feeling you're in a job and not being loads of opportunities out there, I think that balance will be better, and therefore there'll be a little less pressure. I think a lot of organizations have felt around inflation, they've been involved in some sort of referendum by their employees on how much they care. And wage inflation has been very much connected to that. And I think that's been particularly difficult. I think mindsets will change around that. So we do see the labour market, we do see labour demand cooling, and we think that cooling is going to increase. We don't think that's then going to produce a massive amount of further choice for people in that market. We think hiring will become a little easier, but not much. There'll still be those challenges, but I think it's going to be less on salary. So we feel that wage pressure will probably lessen as we go through. And I suppose those would be our main points.
Actually, Jonathan, that pops up one of the questions that I think is exercising a lot of people, which is this wage gradient. And I know it's something that's very prevalent in my sector, that people are voting with their feet, or rather not voting with their feet, voting with their laptops to work for London firms who are paying ridiculously inflated salaries. But of course, the hybrid working model is allowing them to do it from Birmingham, Coventry, Leicester, Argyll, wherever they happen to be. What's your take on how that kind of wage gradient is going to develop?
I mean, I think obviously there's still the inflationary pressures, as Debapratim showed, is going to keep increasing. So there is a likelihood that on your basic, on a static salary, you're going to feel you have less and less money around that. But I think a lot of people's wage inflation has been around buying people in and the cost of buying people in. Because if you go and hire, there are the issues around London, and there are issues around playing, but there's also just the issues that the person can get 5, 6, 7, 8 offers, and therefore you are always ending up in a competitive format, which is going to push it up. I think that competition will decrease slightly. I think I think the working from London, I'm going to be honest, I don't know where this ends up. There is part of me that feels if you're working at home 100% of the time, you know, the water cooler chat is important. The politics of being around is important. Of knowing people and knowing what's happening is important. And I think people who are too remote, I do believe that will cause some issues. But yes, it is a pressure, but then it gets further, because actually you can employ someone from, you know, if you can employ someone from Reading in London and they're cheaper, well, the next question is you can employ someone from a different country and they're even cheaper than that. And I think that is the next stage of conversations that people will be having. And that will then have a converse pressure on wages, because if they go too high, people say, well, if you don't need to come into the office, I can almost look globally of people who can't come into the office. And that will push salaries down as well. And I think those discussions are beginning to happen around organizations.
I think that's absolutely right. I mean, the trouble for lawyers, of course, is that you need English qualified people to practice English law. But I think, you know, even in that context, you know, we are seeing people being willing to work from a much broader spectrum of areas. So I suppose the question is then, you know, if you have to go out to hire at the moment, how do you go about it to try to get the best value for money?
Well, I think if we look at the sort of clients, and we've done quite a lot of surveys around that, you know, the area people are investing in most is L&D, you know, and the reason for that is that actually most people are looking to hire on potential, now rather than the finished article. You know, and therefore you're hiring someone slightly more junior who's got that potential. They're going to be more attracted to the role because of that, you know, the development within that, and therefore they are spending more money on training those people up to the right level. You know, it's a bit like in sport. If you're going for that person who can make a significant effect on the team today, they're going to be extremely expensive. So people are more going for that potential side. I think the other side, and this is particularly difficult in legal, granted, but what a lot of people are doing is also looking at their current employees who obviously enjoy working in the organization, fit the culture already, and see themselves staying in there, is looking at much more dramatic moves internally than probably we've accepted before. So people moving from engineering into finance, or people moving from finance into marketing. And that fits with what sort of more younger generations expect anyway. They don't want such a linear career. They want to be able to move around to different areas. And we've rather set organizations up a bit more linear. So, and that then obviously helps retention as well. But really what people are doing is slightly younger, slightly more junior, and doing it on potential.
Yeah, I mean, I think that retention piece is absolutely critical. And I think it's as true in our industry as in any, that, you know, particularly, you know, you're right. If you take somebody in, you can bring them on and develop them in the way that you want them to grow and build them into your. But you've got a known quantity. Deb, I wanted to ask you. One of the sort of discussions that's been going on is, and obviously we're seeing the strikes as a consequence, is the extent to which businesses are in a position where they have to increase wages in line with inflation. I mean, and I know that there's a sort of an economic take on that, which perhaps it would be useful to sort of understand, and, you know, perhaps give some thought to how one should position oneself in that.
So I think the simple economics is that if employees are seeing significant inflationary pressure, and if you are running a very tight labor market, then typically they can demand wage rises because that is what the market would, you know, deliver them anyway. The interesting thing is actually in the UK, what we've seen is that has been true for the high value, high productivity end of the labor market. So quite unlike the US, where actually in the US there's been a significant shortage of people in retail and hospitality because many people went back to their homes, which is not always in urban areas, and you know, many people haven't come back, and so there's been a sharp rise in wages in retail and hospitality. There was some of it that we saw last year in the UK, but overall, if you look at wage pressures, what has happened is in the high value, high productivity sectors in the UK, we've seen those market dynamics play out, which is that there's been high demand for people, that people have found it easy to move jobs. And also at a time of very high inflation, it's been quite easy for them to argue for significant pay rises. What we are seeing with the strikes and you know, industrial action so far this year is a different side to that labor market. And I think, again, if you've got skills that really are short, you could probably demand quite significant wage rises. Whether the government and businesses decide that the skills of the people that are striking are at a shortage to them, it remains the bigger question. So I think it's one of the reasons why they're striking is because they probably know that rather than the market, they need the business and governments to actually raise wages or you know, to raise their package for them. Another point I'd like to make, and this is about the point you made about, very good point you made about tech and digital skills, you know, which the UK is obviously short on. And in the short term, I think recruitment difficulties will continue, but there is one big change that is already happening now with interest rates rising. We are seeing that to some extent in the bigger tech companies at the moment, where there's been a rise in retrenchment and layoffs, and it's partly because a lot of them actually overextended during the pandemic, so they hired quite, an additional number of people than they really needed, and so now they're normalizing their headcount. But what we will see is a lot of small businesses, especially small tech businesses, which had quite inflated valuations because interest rates were quite low, and many investors were happy to fund a loss-making business with the idea that at one point they'll have a massive subscriber base which they can then monetize. I think that is going to be challenged increasingly, and in fact we're seeing that to some extent. We're seeing that begin. As that happens, on the small and medium side, or typically tech startup side, you might start to see actually quite a bit of slack opening up in the labor market as people find themselves in situations where they were working for a startup, but essentially there's significant retrenchment happening because investors are saying you really need to show us profitability at the moment. So that is something to bear in mind for the medium term in the UK.
Does that also, though, offer investment opportunities for those who might have deeper pockets?
Presumably, but I think this is a combination of factors. So we've got businesses, the established players, that tended to mop up small businesses or startups, them retrenching themselves. So there's, as we're seeing with Twitter, as we're seeing with Meta, there's there are layoffs happening among the big businesses in that sector. I don't think this is quite the moment at which they might think that here's a good opportunity for us to snap up a business.
If nothing else, because if you do need to leverage it at all, you're going to be paying a fortune for the debt. So the other question I wanted to,
No, sorry, I was just going to jump in. Sorry, I went off at the critical moment. One question I actually had. I am back. Yes, thankfully. But one question I had for the panel was about, we've been in this position. It's felt like we've had uncertainty really since the GFC. Frankly, obviously we've been staring into markets like this previously and sort of trickier waters. What learnings have we seen from the market from previous times where we've been in a similar position, and what learnings have you guys had in your businesses which we should look to apply going into the sort of territories that we're going into over the next 3 to 6 months?
Do you want me to jump in? I'll jump in on that one then. I mean, I find in myself a lot talking about the banking crisis in the last few months, and obviously we don't see it being anywhere near as severe as a drop in that. I mean, I think 3 months after Lehman's, we were seeing a sort of 40 to 50% drop in business, and I don't see it being anywhere near that. But I think what we are doing, and it is more about looking at particular markets. So we're shifting into markets that we see will be less affected and moving people out of maybe more standard markets, which we'll see will be more affected. So I suppose going back to Debapratim's comment about particular skilled areas, then actually we're shifting more into that. And I suppose rebalancing the organization around that and trying to use our people better than they were before. At the moment, for reasons that we said, we're not seeing wholesale change, and reduction as we saw before, sort of not total battening down the hatches. So that's the sort of way we're going about it.
Kath?
Yeah, happy to follow on from that. I think the first thing you learn is that it's different every time. And certainly, every time, we all came out of the credit crunch going, well, that'll never happen again. Or, we won't let that happen again. Well, we won't, but something else has happened instead. I think one of the challenges that this particular environment presents is a much greater risk of insolvencies. The credit crunch produced this incredibly benign period of interest rates, which of course meant that a lot of companies could just about skate along servicing their debt. I think what this one is going to do is really sort the sheep from the goats in terms of businesses that have got genuine profitability as against those that are just getting by. So I think for us, that's meant the obvious shift into ensuring that our restructuring and insolvency teams are fit and well and ready to run. And a bit like Jonathan, we're looking at making sure that we've got the right resource in the right parts of the business to allow for that. And that's as well as then looking at obviously making sure that our own business is correctly resourced. It has the right cost base and all of the things that we have to manage around that. But I think I agree. I don't see a really long, really deep recession here. I see a bumpy 6 to 9 months. And I think the challenge is going to be that there are going to be moments of extreme intensity that are, and I think businesses just need to work out where those peaks are going to come for them so that they can be planning for managing them.
Debo?
Just at a high level, as I said, what we tend to see businesses do during these periods is really focus on costs and cost reduction. And I think that is going to happen. The extent to which businesses do that depends on how they've dealt with the pandemic. So say, for example, if you're a retailer, or if you're in the hospitality sector and you've already gone through significant cost cuts during the pandemic because of the hit to demand, this is a very different period, because you'd be thinking, how do I predict demand for next year, especially if consumers cut down on discretionary spend and going out, and then try and hold on to what would be a fixed amount of labor, so that the business is stable. Whereas if you're a big business, you might think we've really struggled to hold on to people with certain skills, and they're difficult to come by. So we're going to look through this and somehow just absorb this within our margins. If you're a small or medium enterprise, you might find yourself in a position where really the only way to survive is to cut costs very aggressively. The one point I would make, though, is this is what we see in all crises, but our most recent experience of a recession is the pandemic. And after the pandemic, when businesses saw the surge in demand, it's actually businesses that held on to labor to some extent, especially in terms of in travel and hospitality, that tended to be, they were first off the blocks and tended to do better. So many businesses will also have seen that experience and will be thinking, those that can, will be thinking, how do we optimize our business for the new world after this? And I think the big question there will be, this is going to be a high interest rate world. And for certain businesses, that might mean a very difficult environment. For others, it might not make that much of a difference. So for example, if you are a car manufacturer, and in the UK, actually more than 90% of new cars are now sold on PCPs or some form of finance, you'd be thinking, well, interest rates are going up. How do we optimize our business for a high interest rate environment? Whereas, as I said, if you're in hospitality or retail, you'd be thinking, well, what's the kind of demand that we might average over next year, and how do I, kind of manage the business for that? And then we'll see, once the pickup comes through in activity, we'll see how we adapt.
I'd 100% concur with that. I would say we've definitely seen that in our business and with a lot of our clients. And the one thing I was going to say is that as a real trend, typically when we've been in these waters previously, succession planning, skills matrix has gone out the window, and actually we've been in an unsustainable position, especially in the UK, on buying in talent at a qualified level. And in these trickier periods, we've sort of done away with entry-level recruitment, and we cannot move away from the importance of that, because it's not going to get any more simpler or easier to get hold of good quality qualified talent. It's going to continue to be difficult and protract in different ways. So the braver we can be on entry level and bringing people through and keeping succession planning on the table, as difficult as that might be, I think will really help in a bounce back, because that's always the mistake we make. And it's I appreciate it's difficult.
I think the other thing that plays into that really importantly is diversity.
100%.
Is looking in different places for talent, and really sort of broadening your mind to what's available, and working with local communities to draw out the talent that is there, but maybe is just not being seen.
I was going to say, but I mean, I think Kath is right in her point before. The graph that scares me the most in quite a lot of quite scary graphs is that one on insolvencies, because it is that mix of increasing cost and everything. But I also think, going back to what Debapratim said, yeah, people did know that if they held resource, they were better afterwards, but people holding resource is also going to increase the number of insolvencies. And one of the difficult balances at the moment is, you know, whilst for us trading, we can see trading dipping and getting lower, and therefore consultants' chance to make money is reducing, we're also having to become tougher on credit risk and credit management. And we're saying no to more companies, which almost feels you're working against them further being able to make money, and that's a tricky one to be dealing with at the moment, because trading's going to be harder, but you're going to be tougher with who you can work with, and that seems to sort of work against each other. But I agree. I think the insolvencies one is a scary one.
Yeah, and I guess it's compounded by the sort of support given during the pandemic that's never been seen before, that actually got businesses through that weren't necessarily sustainable, that are now going into trickier markets than they've seen previously. If there was one, just trying to bring this to an optimistic point, where's the opportunity here? Where do you guys see the opportunity? If there was one area you'd say there's a real opportunity, where would it be?
Shall I kick off with what we're seeing in terms of the survey and what big businesses seem to see as an opportunity here? So a lot of big businesses have made big investments in technology, digital technology, over the last couple of years, partly accelerated by the pandemic. They've got deep pockets. They can look through this recession, especially, you know, if it is, you know, of a milder nature as everybody's forecasting. And you know, they really have the capacity to make the most of this investment in technology. So past the financial crisis, we've been through a period of cheap and plentiful labor, and therefore low investment from businesses in technology, and weak productivity growth, partly as a consequence of that. And this has been simply because for many businesses, it just made sense for them to hold on to cash and hold on to labor, because labor was cheap and easily available. We are going to be looking at a very different environment. I mean, you know, there's higher costs, there's, you know, more friction in access to labor, and all of these things, and the big investments that businesses have already made, do set up for a medium-term, you know, perhaps, you know, a medium-term pickup in productivity growth, which obviously in the longer run, we think means higher living standards for people. We've got to see whether things play out in quite the way that I set out, but that is one optimistic view that you can take from this environment.
Thanks, Debo. Kath, Jonathan?
I'm thinking hard, but it's a struggle. I think I think the social opportunity is quite important in terms of this opportunity to broaden the base of one's workforce. Yeah. And actually, I think the retention point is critical as well, because I think businesses that retain their quality and develop their own people are going to have a strong advantage, you know, at the end of this, because they're going to have a more engaged workforce. They're going to have a workforce that has a degree of loyalty in a world where perhaps that's becoming a less common thing. So I think working on those relationships is an opportunity to build a really strong foundation.
Yeah, I would echo that. And I hope diversity and inclusion is the winner of this. I really do. And neurodiversity, which I think is starting to be in the conversation, whereas been previously ignored. Jonathan?
I think, you know, it's very difficult to describe 2022. I mean, almost every organization has made a lot more money, and financially it's been phenomenal for almost all companies. But you know, I describe it as a bit of a fake market, and there's been sort of almost a bit of madness around. And I think sometimes it's felt, if you're an organization that has much as possible try to stick to your business principles, you know, to the economics that you know and that you understand, that you feel fit to your market. It almost feels you've been a bit punished for doing that, and, you know, seeing madness around the market, and we've all lost people and gone, what, you know, how can this be? And I think those companies that have been stable and kept their business principles and kept a common sense, I think they'll be the winners through this downturn. And I think there will be opportunities out there because, you know, whilst insolvencies hits our bottom line in terms of making money, it also obviously increases our competitiveness out there. And I think those who stuck to what they're doing, I think will find the advantages through the next one. I think, you know, one thing I've advised everyone is everyone's lost really, really good people in the last year. Keep in touch. Ring them after 6 months, ring them after a year, you know, tell them that you missed them and that you'd really like to have them back, because I think there's going to be a lot of people coming back to organizations and finding that, you know, life wasn't there, or moved purely for salary, and that probably rarely works in life. So I feel a bit of common sense is going to come back. I think the secondary bit, as I think this all feels worse because it seems very trendy at the moment, particularly in the media, to bash corporate UK or the UK as a whole, how we're seen in the world, how we trade, how we do everything else. And, you know, as part of my job, I speak to managing directors across the world every day, and I just don't think it's true. I think our reputation, I think how we're seen as a trading business. Okay, the 2 weeks of Liz Truss didn't help, but outside of that, I actually think we still are seen incredibly positively, and our opportunity to trade internationally is far better than is sometimes portrayed in the market around that. So I think we went through a very tough period, our post-Brexit. We've been through sticky markets, and I think actually in some respects, the business is much better set up. And even looking most recently in this last quarter, you know, I've been on a call which was told that the French market and the German market, you know, in this last quarter has been performing considerably worse than ours. And I had to look sad, but there was part of me that was smiling in that. So I still think we're well positioned, and we're used to working through these tough markets. And I think the UK will do all right.
And actually on that trend, we've had a question, actually just thinking about the UK strengths. And the question is the UK at risk of losing its innovative edge? It's obviously been an area we've excelled in, and it feels as though our innovative SMEs are going to suffer, and maybe innovation will with it. Any thoughts and comments?
Well, I would say I don't agree with that, because, you know, if you look for us, we would say one of the most exciting future markets, and one of the markets that's going to grow the most in the coming 10 to 20 years is life sciences, is the drug development, is all around health. And, you know, with that golden triangle around sort of Oxford, Cambridge and Imperial College, you know, we lead Europe in that area. So we are producing more scientists. We don't have enough of them, but we are developing that more than any other organization. And we still see a considerable number of companies coming to the UK from Europe to set up, partly because of the financing they can get, the skills they can get in order to develop that. So I think actually that innovation and development of new organizations, I think that's our strength.
I mean, I agree completely. I mean, I talk to a lot of funders, and, you know, almost with that exception, when you say, okay, what are your key sectors, you get meditech, you get life sciences, you get health and care, you know, you get nanotech, you get all of those innovative industries that I think we are good at, and it's still recognized that, you know, we have a leading edge. So I think the challenge for those kinds of business is commercializing themselves correctly. There's always that difficult point of going from being a startup to you know, being a developed business, and it's getting over that hump where I think, you know, that some challenges will lie.
And do you think it will be a trickier journey now to accessing finance for some of those businesses that perhaps have probably got there sooner than they probably should have done, or maybe had a slightly easier ride historically?
I think that you are going to find that, you know, you're going to have to think a lot harder about how you fund, because obviously the price of funding has gone up.
Sure.
I think there's a funding appetite is still there. I still think there's also a lot of private cash that is looking to move into those kind of sectors. So I think the answer to that is if you're any good, you'll be all right. But if you're, to quote Arthur Ransom, only duffers drown. So don't be a duffer. I think good quality propositions will probably do okay.
Debo, any observations from your side?
Actually, exactly the point that Kath made, which is in this kind of environment, we see a flight to quality. And if you're a quality proposition, you shouldn't be short of options. This is what we saw with governments in sovereign debt during the Euro debt crisis, where there was an increasing discrimination made between governments that were seen as more solvent, more creditworthy, than governments that weren't seen as creditworthy. And we're going to see something similar to that at the corporate side now that rates rise. I think greater competition in general should be a very good thing for actually innovative British businesses, because arguably they would shine compared to other competitors in a more difficult environment.
Yeah, agree. Thank you. Hopefully that answers that question. I think we've got time for one more, Rosie. We've got time for one more. Yes, I'll take silence as a yes. We'll keep going. It was another recruitment-led question actually from Paul, which was about the impact of the interim market, both short and medium term. Jonathan, I'm sure Kath, you probably see a bit of this as well. What do we think the impact will be going into this environment? Obviously, we had the sort of reversal of IR35, which naturally has an impact from Mrs. 2 weeks, who we spoke about earlier on. But how do we think that will fare in the market? And is there an opportunity for businesses to plug the gap using interim resource?
Yes. I mean, obviously, I think there is to plug the gap. I mean, I think it's been a very, very difficult market. I think people are very unsure about it. A lot of clients say to me, it just falls into the too difficult category. I don't really understand what I'm going to be doing and what I'm not, and the amount of paperwork and issues around that. But everyone's been hiring on a permanent basis, so it hasn't really been so much of a factor this year. One of the difficulties we've had in our interim market is if we place someone who's good, they make them permanent. If they're not so good, then obviously they're not so good, and that doesn't work. I think the more interesting side will be when headcount freezes come in, which are coming in already, and we're beginning to see that, where people have work but they've got a freeze on, and that is historically where they've gone to that temporary market. But it's been an onslaught to temporary. Look, the unions a long time ago were anti-temporary employment because companies used temporary staff to avoid some of the rules and regulations they had to work to. So it's been an onslaught from the unions against temporary staff, and to a certain degree, the amount of compliance that's come in around those and the expense of those has probably reduced those numbers. However, it still does give people flexibility. It does allow people to recruit off headcount. A lot of departments used to hold, and finance departments particularly, just a percentage to give themselves ease. I think that will all come back, but I think people need to be forced into it a bit from having to go to that market to realize actually it's not as complex as maybe some of the HR departments have made it feel.
Thank you. Kath?
Yeah, just I think for a lot, it's a question again of horses for courses. Yeah. I think that there are circumstances in which actually the temporary markets can be incredibly useful, particularly if you're trying out new skills or wanting to, experiment with new areas that perhaps you don't want to hire immediately for. I think again for a lot of businesses, it's not the answer because it doesn't build that long-term loyalty and that long-term relationship that is what ultimately plays back into, in the next, in a year's time, who you retain and who you lose. So I think it's like so many of these things used judiciously. It's a good tool. From the sort of the employee market point of view, I'm not sure that one would be rushing to rush off and be a consultant rather than be a permanently employed person right now.
Yeah, okay, understood.
The only thing I'd add is I think, the conversations we're trying to shift a little bit to organizations is sometimes, look, rather than giving us a job spec, look, tell us what the problem is, or what the plan is, or what the issue is, or what that is. And let's look at what the solution is. Now, that might be a permanent person, but they're going to cost this much probably in order to do that. That might be a temporary person who's going to cost this much. And there's, you know, there's pros and cons of both. It might be a team that needs to come in there. It might be you need to employ a consultant. It might be Milan is the key, you know, but actually more of, because too often people's solution is a job spec that the market then can't fill. So they don't solve their problem from that. And I think it needs to be a little bit, look, what are we trying to achieve here? Let's look at the whole spectrum of ways one can achieve that and what the cost will be. And let's see if we can find what is probably the best solution, because it might not be that permanent person, because they're not there, or they're very, very expensive.
Yeah, agree. Good. Any more questions from the floor? Nope. Thank you. I'll pass back to you, Rosie. Thank you.
Okay. Well, just to say a big thank you to all of our speakers this morning. It's been a very insightful session. Sounds like we're in for a bit of a rocky few months, but there is cause for optimism out there as well. Also to say thank you to those of you who have joined us today. Just quickly to say this is just one of a number of events that are held by the Chamber every month. So we're reaching the end of the year, so things are starting to wind down, but there are a few opportunities to come out and see us over the next few weeks. We have a networking session in Bracknell next week at 3M's offices. That will be taking place on Wednesday. We have a business leaders forum taking place in Reading on the 24th of November, which will be on the future of work. And dare I say it, we have a Christmas lunch coming up on the 15th of December. So if you're interested in attending any of those events, please do take a look at our website or get in touch with one of the team, and we will be happy to help you. So thank you once again to everyone, and I wish you the best for a lovely day.
Thanks, everyone.
Thank you all.
So